today we're trying to connect, well, what seem like two really different stories shaping the global economy.
Yeah, on one side, you've got these almost frantic moves by central banks.
Right, trying to prevent some kind of meltdown. And on the other, China's laying out this very deliberate long-term plan.
Exactly. Our mission, I guess, is to sort of tease out the hidden links, the tensions between these immediate crises and that long game.
What jumps out is just how aggressive the shifts are. You've got this Western financial system kind of struggling with huge debts, clogged up plumbing.
And then China, the world's #2 economy,
Right.
making this big pivot, trying to become less reliant on the rest of the world.
Okay, let's dive into the first piece. The source easy world. It points out something pretty startling about global interest rates.
What's the headline number?
312 rate cuts by global central banks in just the last 24 months. Well, it's almost the peak pace we saw back in the 2008 crisis.
Wow, 312. And the kicker is, we're not officially in a recession, are we?
Nope. No official recession declared.
So that's really telling, isn't it? It implies these cuts aren't just about, boosting slow growth. It feels more like an emergency response.
To what, though?
The thinking seems to be the sheer cost of servicing all this global debt. It's becoming crippling. Maybe this is a kind of coordinated move. Cut rates now.
To deliberately create inflation later and sort of deflate away some of that debt burden.
That seems to be the undercurrent, yeah. A sort of hidden agenda, maybe.
Well, if inflation is the goal, the numbers seem to be heading that way. Let's look at the inflation report. The U.S. September figure came in at 3.019%.
Okay, 3%. But that's just 1 month. What's the trend look like?
That's where it gets interesting. The 3-month annualized average spiking. It's running at 4.75%.
4.75%. Wow. So the upward trend is definitely there. And the source mentions tariffs starting to push up goods prices.
Yeah, finally hitting consumers, it seems, which brings up this idea of complacency, right? That's from the source, complacency.
Right. If inflation's actually trending towards like 5% annualized, why is the bond market, which is supposed to be the ultimate judge, acting so calm?
It's weird. The source says the market seems to think there's no problem.
How can that be?
Well, the suggestion is that maybe the bond market expects central banks will just quietly drop the strict 2% inflation target.
Okay. So they'll just accept higher inflation, normalize higher rates as the new way to manage all this debt.
That seems to be the theory. And this source even touches on concerns that official numbers, like from the BLS, might be getting massaged, is the word used?
Massaged.
Yeah.
Certainly a claim. Makes you wonder.
Okay, let's pivot to the U.S. system specifically. The source, we need a plumber. It says rate cuts might be needed because, yeah, the job market's slowing, real estate too.
But the real problem, the deeper one, is structural. The financial plumbing is just clogged up.
And how do we see that? What's the evidence?
The big red flag is SOFR. That's the key interbank lending rate, trading above the Fed's discount rate.
Which is the rate the Fed charges for emergency loans, right?
Exactly. So if SOFR is higher, it basically means banks are hesitant to lend to each other directly, even when it should be cheaper. It signals a lack of trust.
Okay, so banks don't trust each other. Plus, the source mentions low reserves, below $3 trillion.
Yeah, reserves are low. And many banks are sitting on these long-term treasury bonds that are way underwater marked as held to maturity, hoping they never have to sell at a loss.
So a stress system. The Fed had to do something. What was the move? Not a foregone conclusion, has the details.
Well, they delivered the expected cut, 25 basis points. No surprise there.
But the big thing.
Yeah, the monumental move was halting QT, stopping the balance sheet runoff, quantitative tightening, starting December 1st.
That's basically turning the liquidity taps back on, isn't it?
Absolutely. It's a huge liquidity injection. Powell tried to sound cautious about a December cut, mentions strongly differing views on the committee.
But stopping QT is a pretty loud signal.
It really is.
Yeah.
But even with that, the source SOFR tension persists. Says SOFR is still high compared to IORB, the interest rate the Fed pays on reserves.
So halting QT wasn't quite enough to immediately fix the plumbing issue.
Apparently not entirely. The Fed's now reinvesting runoff from mortgage bonds into short-term treasury bills. It's a very targeted effort to, grease those short-term pipes.
Trying to prevent what the source calls credit cockroaches, small failures that spread.
Exactly. Avoid those small systemic cracks turning into a major credit crunch because that internal market trust isn't there.
Okay, deep breath. Let's shift gears completely now. Away from the immediate firefighting towards the long game. China has a new plan.
Right. This is their 15th five-year plan covering 2026 to 2030. And it outlines 7 core targets that signal a really major ideological shift.
A shift away from.
Away from the old model of just growth based on scale and exports. The new focus is clearly on productivity and overwhelmingly driven by domestic demand.
Domestic demand. How much?
They're targeting 86% of GDP growth to come from internal consumption. It's extraordinary.
86%. Wow. And what are the pillars of this plan?
2 really stand out. First, scientific and technological self-reliance. That means massive investment in AI, semiconductors, clean energy, basically insulating themselves from global supply chain pressures.
Building their own capabilities. And the second,
Ecological civilization. A huge push towards green energy, aiming for non-fossil fuels to power over 30% of the country by 2035.
okay, so let's try and pull these threads together for everyone listening.
You've got the West grappling with this enormous debt burden, resorting to pretty aggressive liquidity measures, possibly having to accept higher inflation just to keep the system afloat.
And at the exact same time, you have China strategically building up its own tech independence, focusing its economy inward on its own consumers and going big on green energy.
2 massive economic systems, seemingly heading in different directions.
So here's the final thought to leave you with. Considering the West might need global cooperation, maybe even inflation, to manage its debt, while China is actively focusing on self-reliance. What actually happens to global trade, to resource flows, to, well, everything, when the world's 2 biggest economies start operating more on parallel tracks?
Yeah, instead integrated ones. What does that future look like? Definitely something to chew on.